You're listening to the RITE Retirement Show.
70% of people out there listening to the show today are going to need some level of care. It doesn't necessarily mean that 70% are going to end up in a nursing home, but 70% of people will need some assistance out there. The biggest fear is running out of money for the retiree, but what we see is not enough people spend enough of their money.
Chris prides himself in what matters to you. This is the RITE Retirement Show.
Hello, I'm Luann Fulmer, and welcome to the RITE Retirement Show with certified financial planner and financial advisor Chris Wallace. He is also president of WG Financial Group. And then also joining us from the firm, Graham Bauer. He's a certified financial planner, financial advisor, and enrolled agent at the firm. Both here again today on our show to give you helpful advice about retirement planning. And then we have a guest. Very, very excited to have Kelly Myers here again today. He's a tax consultant of Myers Consulting Group, LLC, based here in Huntsville. And Kelly spent over 30 years with the IRS, last 20 years working at the Washington, D.C. headquarters as a senior technical advisor. So excited to have him here today. And I just want to welcome all of you. So excited. We're going to be discussing the One Big Beautiful Bill again.
Do your Trump voice, Luann. I want to hear it. I want to hear it.
Got to say that pre-show.
Really it's really big. It's golden.
Yes.
It's huge.
I don't know. It's huge. Yeah.
So I did mine pre-show, and Graham said it sounded like Batman.
It was pretty bad. So we're not going to subject the whole greater Huntsville area to it.
No, we're gonna just withhold that for sure.
Well, anyway, and Kelly, welcome. So happy to have you here.
Oh, thank you, Luann, and glad to be here with Chris. And just trying to support and sort some of this out, right? We're trying to sort out some of this big, beautiful bill along with everybody else.
Exactly.
Yeah, I think what I like about having Kelly on the show is our listenership goes up when Kelly's on the show. We get more downloads and listens. So maybe we just ought to make him a regular part of the show.
Yes.
Yeah.
Excellent. That would be great. So yeah, let's get started. Kelly, just in terms of the One Big Beautiful Bill, I'll kind of lead with a personal story. My dad doesn't really listen to the show, so I'll kind of talk a little bit about that. So he and I were having a conversation, and let's just say it this way. Dad he doesn't like our current administration. He's not a big supporter of, President Trump. And we were talking about the tax, the tax bill that just passed. And I was talking to Dad about how I thought it was incredibly helpful for the senior citizens, especially the retirees, the baby boomers, people over the age of 65. And one of the things that, Dad said was it just added to the debt. And I said, well, yeah, that's true because there's not enough tax revenue, or there's less tax revenue coming in. So it essentially adds to the debt, but it does it in the form of they're just not collecting enough tax revenue. So Kelly, you and I were kind of talking a little bit just a few seconds ago, and I'd like for you, if you could, just to kind of repeat like where they're measuring that number from and really why that is.
Sure. I'm glad to. And I think that's, we get all this political messaging and we have to sort through all that. But keep in mind that the vast majority, if not the vast majority of the individual tax provisions that were passed back in 2017, they were going to sunset. As in tax law discussion, that means they cease to exist at the end of 2025, and we go back to prior law. And prior law had a lower standard deduction. It had tax rates that were higher than we've been living with since 2018. And that's where they're saying the increase. So what the law did is made those items permanent, higher standard deduction, higher estate deduction. Those things were higher now. So it's permanent until the next Congress changes them, right? But The difference, so they're saying where we have this increased debt. Well, the increased debt, when they talk about that, is because here's what the debt, if we did nothing, the revenue was going to increase because now Dad's going to have to pay more tax because he has a lower standard deduction. So now they're saying, well, instead of Dad having a $12,000 deduction for standard deduction, now he has a $30,000 standard deduction. That's where they're saying we have less revenue. And really all we're doing is carrying on. The bill just carries on what's been going on in terms of deductions and standard deduction and tax rates, been carrying forward what's happened since 17. So it's a lot of revenue neutral if you consider the fact that if we measure from today and what the current law is allowing, say in 2024, to what it's going to look like in 25 and 26, that's a lot less of an impact than what you're hearing because people want to go back and measure pre-17 law compared to current.
Right. And I think one of the things that I was explaining to him is it doesn't matter what our current administration does. He wouldn't change his mind. He could cure cancer for everybody. And the Trump haters, so to speak, would probably not have a favorable opinion. And so I went on to explain to him that, if the tax codes tax rates had reverted, and I've gone over this before on the show, but I'm going to say it again, the 12 would have become the 15. And that's a 25% increase in marginal bracket right there. From 12 to 15 is a 25% increase. And from 22 to 25, it would have been a 13.64. And from the 24 to the 28, it would have been a 16.67% increase. And I don't know, Kelly, we've talked about this on a show before you weren't on the show, but that's kind of the middle class. That 10, 12, 22 area is kind of the middle class. Even up into the 24, I would argue that's kind of the middle class. And that whole middle class would have seen a fairly substantial increase in marginal tax rate.
Right. And it's the marginal rate. But on top of that, you think of the standard deduction, which is currently at the new bill at 31.5 for a married joint. Mm-hmm. Well, 31.5, if we would have reverted, we'd be to somewhere down in the 12, 13, it'd be index sum. But call it at least 50% of that. Mm-hmm. So now you have a higher taxable income, right? It's increased by, say, $17,000, $18,000 at that 22%, at that 15%. Well, that's a couple $1,000s a year just in that one component of additional tax. So you could have, mom and dad, seniors, they're out there paying more in 2026 if they want to pass this bill to the tune of several $1,000s. Mm-hmm. From what they've been paying over the past several years. So it's impactful at the individual level. And yes, a lot at that middle class and, middle income folks.
So one quick question for you on staying on the standard deduction side of things, because I do agree that is probably more significant for most people than maybe even this 12 to the 15% bracket, just based on people who would be primarily in those brackets. So I know this year the IRS has, it's shrunken a bit. I think somewhere around 20,000 plus employees between the DRP and the RIFs. Do you think that any part of keeping the standard deduction high has to do with, the fact that so many people just take the standard and not having to deal with itemization as, the IRS has just less employees than they have in the past? Or do you think it's strictly a, just tax savings for the average American?
Yeah, I think it is what the government would refer to as taxpayer burden. And there's a lot of non-compliance in itemizing. And from a resource standpoint, it goes before the current administration shutting down. They've been going this way a long time. Is if I just give somebody $30,000, a married couple joint, give them $30,000 standard deduction, millions and millions of people stopped itemizing. So from an IRS standpoint, we don't have to worry about auditing these the lower income individuals. There's minimal tax savings there. Compliance goes away. They don't have to spend resources on it. And it's less burden on the taxpayer, right? Because if you're paying a little bit of mortgage, you're paying some itemized deductions, some interest and taxes, those things, you come up to $26,000, $25,000, $20,000, you just take a $31,000 deduction. You don't have to worry about itemizing. Right. And it's much more beneficial to you tax-wise than having that very low standard threshold.
I'll tell you something funny. It's a great point, actually. I love this conversation because I was talking with someone the other day, and this wasn't my dad, by the way, but this person was angry because they don't get to itemize anymore. And I was thinking to myself, that's probably because the standard is actually higher than your itemization, and it's probably helping you, and you're just looking for something to get upset about.
Yeah.
So,
It is a funny mentality to kind of think like, I would rather get to feel like my house interest and property taxes saves me on taxes, even if I'm saving more, just checking a box instead of keeping, receipts and doing all the legwork.
Yeah.
Now, the challenge you do have, and as a caveat, you need to keep in mind, we're talking federal tax. State of Alabama threshold for itemizing is very, very low because their standard's $1,500. So even though we've gotten rid of like Graham's pointing out, this burden of record keeping for itemizing, many people for a state level, Alabama or another state, you're still itemizing on the state level when you don't itemize at the federal.
Right.
So that's from a tax planning standpoint, you need to keep that on your radar.
Yeah, according to the Tax Foundation, with these new rates, about 86% of people are going to actually use the standard. So
right,
most people, you could say, and be right and say most people just use that standard deduction, which does make things a little bit easier. I didn't think about something that you mentioned earlier is during the itemization process of doing your taxes, I guess the taxpayer can have some quote unquote gray areas. And I won't say, I don't want to use the word lie, but maybe just not understand the tax law appropriately and maybe itemize something that isn't necessarily itemizable. And so that would require an audit to find out if that, really occurred. And just by using that standard, I think this was your point earlier, it just kind of eliminates that risk.
Correct.
Yeah. So let's get a little bit into it. I know you'd ran a scenario for us. Obviously the show that we do is really geared towards the pre-retiree and retiree. So let's talk about a taxable scenario that you put together. You shot me a photograph of it earlier in the day. And I'd like you to just kind of walk through the married couple scenario. And then if there's, the loss of a spouse, I think is the other side of that.
Right. So we're trying to just think through and be able to walk through a very high level scenario. And like I say, if we're retiree or we think about somebody that's in retirement, let's just narrow down, say they have two main sources of income. They're getting Social Security and receiving a pension, or maybe it could be other portfolio income. Say the Social Security component of that is $60,000 of taxable, and then the remaining pension and other income is another 50. So if your adjusted gross income is 110,000, by example, if you're married filing joint over 65, you're going to have a standard deduction of 31.5. Because you're over 65, you each get another 1,600. So that's 3,200 deduction. And now you have this new, what was termed early on in the tax legislation as tax exempt Social Security. Because of a lot of legislative rules, we end up with what there's now called the senior deduction, which is an over 65 or 65 and older, you get an additional $6,000 deduction. So for a married couple, that'd be 12. So now your $110,000 of income is reduced all the way to 63,000, and you pay tax on that at a marginal rate. You can pay some at 0, some at some at 12, or some at 10, some at 12. Your total tax on that, your marginal rate's 12%. You're paying tax about $7,100, and married joint. And if we didn't have the law, we could, your income would be, if we didn't have the new law, by example, your income would be 12, it'd be $25,000 more than that or greater. So there's your tax savings. So that's kind of the married joint when you think about it. And the kind of the key point in there, I think a lot of people need to focus is this, what we call marginal tax rate. So if you earned another dollar, how much would you pay in federal tax? And at 12% marginal rate, you'd pay another 12 cents on every dollar. So if you have a stock sale or you have taxable interest or taxable dividends, that's where you need to work with the financial planner and your tax folks and say, how do I act most efficiently in a tax manner for that 12%, whether you're doing Roth conversions or other strategies?
So on that, one thing, as you're talking about that I was thinking about. So one kind of interesting thing, and we talked about this when we did the longer episode on this new bill, is the fact that a lot of these laws are retroactive to 2025. Now that happens sometimes, but people usually expect that, this will start next year, I guess, because this got passed halfway through the year. But a lot of this is retroactive. So for someone who, I don't know, let's say is, because obviously there's the AGI limits, so is 66 years old, still working, making $80,000 a year, or even just people who are on Social Security and a couple pensions. Should they probably be expecting maybe a larger refund than they would have gotten other years because of this other new deduction that's probably not going to be accounted for on their withholdings?
Yeah, I've not heard about the withholding tables being adjusted. And I really caution the population as a whole for people to say, well, my refund is going to be bigger. They think their tax bill is related to the amount of their refund. And I always challenge people. I said, let's look at what your total tax is, because your refund is really a factor of how much you have withheld, right? Mm-hmm. So if all other things being equal, which I think is really what Graham's observation is, all other things being equal in the scenario we just said, if you're anticipating not having the senior deduction of $12,000, right, of $6,000 each for husband and wife, your refund or your tax bill, really, right, will be 12% times $12,000, right? It's going to be $1,440 more of a refund or less of a tax bill than you were anticipating. So if you have a higher income individual and you see some of these numbers moving and the tax bill affects you greater, then you may want to revisit how you're withholding on you may want to go into your payroll or pension or Social Security and say, I don't need to be paying in that much because I don't want an $8,000 refund in March. I'd rather have that money now, so I'm going to dial that withholding down some.
Right. So just before we get into the other side of the equation that you ran, I just ran some quick numbers, and based on the situation you just spoke about, using this couple with taxable Social Security income, meaning that's the 85% plus a pension of $50,000, it puts them owing somewhere right around $7,100 in tax. And that's a realistic situation for a lot of Huntsville retirees that have military or federal government pensions and Social Security. So I don't know if you did that on purpose or you just kind of pulled some numbers out of thin air. But when I saw this, I was like, that's kind of reality. So if I compare that to pre-OBBB, then it's about a $1,600 tax differential. So had the bill not passed for this particular situation, in 2024, this would be about $1,600 more in owed tax before the OBBB passed. So I think that's something to take note of as well. Go ahead. Sorry.
It is. And I was going to say, anecdotally, what's interesting for Alabamians is the example we use Social Security and pension. Most situations, if it's a defined benefit plan, which most of the pensions are, if you're in that mode, your Alabama income tax is zero. Correct. Because Alabama doesn't tax Social Security and doesn't tax defined benefit plans. So, you have a holistic thing to look at.
Yeah. And so kind of getting back to something you sent Graham a couple of weeks ago when we kind of walked through some of this bill on the show, I think you mentioned that the age 65 extra senior deduction there is an above the line deduction. So let's take that back to Graham's situation where let's say we got a married couple. Let's say they make a gross amount of $100,000 in W-2 wages. That $12,000 extra deduction, does that come off the top of that? Meaning their AGI at that point, assuming no retirement plan or HSA contributions, would then be $88,000?
No, the AGI, it's I say above the line. It's a non-itemized item. So it comes under Code 63. So it's going to be deducted from AGI, similar to what itemized deductions are, but it's not subject. And a lot of people are getting the terminology moved, and we're trying to sort it out a lot of times early on. Yeah. But the $6,000 is not. Big thing is it's not an itemized deduction piece. You're going to get it regardless whether you itemize or get the standard. That's the big component there of that $6,000. You don't have to itemize in order to get the deduction. Okay. But it's not going to reduce AGI. It's going to come after AGI, same place QBI and a couple of others come.
Okay. I think that's where there was some confusion by the way that it's worded. Does that also apply for the extra charitable thing that's thrown in the bill where a married couple could get $2,000? That's really a reduction to adjusted gross income, not adjusted.
It's reduction. Correct, a reduction of AGI. So to your point, so the charity, there's a charitable deduction, direct deduction allowed beginning in 26, not 25, for $1,000 for a single or married filing joint. It's $2,000. So in 2026, you could have a married couple filing joint, take a standard deduction of $31,500. It's going to be indexed a little bit. But then if you also have $2,000 in charitable deductions, you're going to get that deduction as well, even though you don't itemize. And so you could have donor advised fund giving, but you could also have an additional $2,000 out here and get a deduction for that in the current year without having to itemize, which is nice.
Okay. Got it. Yes. All right. Makes perfect sense now. And so let's go back to your scenario. You ran the married couple. Let's say that one of them passes away. And we know that there's a loss of a Social Security. And we also now, the year after death, we're going to be filing in a single filer bracket. And so let's talk about that and maybe the differences there.
Sure. And really, you kind of make some assumptions and say, we know income's going to come down by something, and everybody's situations will be different. We made the assumption the income came down by 20,000. Spouse passes away, loss of some Social Security, loss of maybe some pension, whatever. Mm-hmm. So now that your standard deduction now goes, instead of being 31, it goes to half of that. It goes to 15,750. You still get the 1,600 for being old and taking the standard. And now your $6,000 deduction times 2 that you had for the senior deduction now is only 1, right? So now your taxable income in that scenario we penciled out went from, instead of taxable being married, taxable income of 63,000 roughly. Now your income is roughly 66,000. Even though your income went down, your deductions dropped. Actually, your deductions dropped more than your income did. So now you're at a $66,000 of income, which is a 22% marginal rate. And this is the piece a lot of folks miss when they go from, when you think about being widowed or single, married to single, widow or whatever, is now your marginal rate for the same level of income goes up, and it goes up by 10%. So in the scenario, the tax on that single individual now is now roughly $9,500 versus $7,100. You have a $2,400, $200 a month increase in tax bill. So not only your income went down by 20,000, now you have to pay $200 more in federal income tax.
Right.
And you have to layer that into the tax planning of, a lot of things, how you do pensions, Roth conversions, and designee beneficiaries. But the reality is when you need it the most, if you will, being single and 75, now your tax bill is going to increase when you've just lost your spouse.
Yeah, that's so true. And, the other component, I don't think you mentioned this a second ago, but is the fact that, the income might drop. But, if you're 75 years old, your required minimum distributions aren't going to drop. You're still going to be taking them based on, the amount you have total. That percentage doesn't really change if you're both over required minimum distribution age, if you're, around the same age. So, that's one reason I think that when I talk to people and when we at the firm talk to people about Roth conversions, which I know is not what we were talking about here, but just pivoting a little bit, the loss of a spouse is, I think, a big component of that. Obviously, hedging against future tax law changes, that's part of it, but you don't really know when that's going to happen, what that's going to look like. That's all just kind of conjecture at this point. But, there's a pretty good likelihood that one spouse passes away before the other. I mean, it's statistically impossible for probably you guys to pass away at the exact same time, whether that's a year apart, 10 years apart, 15 years apart, doesn't really matter. There is probably a time you will go from married to single. So I think that's another component as well. But no, that's a really good point.
No, it's a great example, actually, when you sit there and you think about it. I mean, we talk about this and we've looked at the numbers, but I like Kelly's old school way of doing it, because what he did was sketch this out on paper. And I'm literally pulling it up on my phone. You can see this is what he sent me this morning. I actually sent it to you as well, Graham. Yeah. And there's just something about, for me, seeing it written out in old school pencil, number 2 pencil, like we used to do back in the day when I was in school. Graham, this is like way before you. I went to school with Jesus, actually. But to see this differential here is kind of mind boggling. And
I think
what you jumped right in and was talking about Roth conversions, and that's where my mind was going. It's like, that's exactly why we talk about the importance of it. It's not just about hedging for higher brackets. It's also hedging that single filer bracket, which can be brutal there as well.
Well, I think the other practical service, you help clients think through this, and I do as well, is if mom and dad are there living by themselves and doing well and they're up in age, right? They're codependent, right? They're taking care of each other. And now one is not there. So not only income's gone down, all these other factors are moving, but mom or dad, whoever's there, now they need help, right? So now their living expenses are also increasing, right? So how do we help them manage through that? And I don't want to say the human side of it, right? But there's this element of all these moving parts that we have to keep in synchronization, right? And so it's a big shift, and the extra tax burden is just another layer on top of that we need to be cognizant of.
Yeah, there is. Is there anything else in the bill Kelly, that just jumps out at you as like this is a big deal for most people? They should really think about doing such and such. I know that there's, I'll just kind of mention one, the accelerated depreciation is back to 100%, and I think I want to say it was like January 24th or after your piece of equipment or vehicle or whatever had to be put in service after that time. I'm of the mindset that I'm not a big proponent of spending money to get a deduction unless you need it, right? So let's say you're going to buy a car probably in the next 1 or 2 years. Well, then I could kind of see buying a company vehicle where you get that accelerated depreciation. I can't speak, but to just go out and spend the money, I'm not really a proponent to do that. I think you end up hurting yourself just trying to chase a deduction. Any thoughts on that?
Well, it has to make business sense. So accelerated depreciation, when it came back, research and development is a bigger business issue that came back that's really pretty huge in the Huntsville market. They reinstated what it used to be a few years ago. But with the accelerated depreciation, I think there's really opportunity there. You have to look very holistic. And I grew up in agricultural community where people were like, buy a tractor, you get a tax credit depreciation. Well, all the farmers were losing money. They didn't need credits or depreciation, right? But if you're in a business and you buy an asset and say, hey, I can get accelerated depreciation, it's an opportunity often. They say, well, I'm buying this asset. I'm going to get this huge windfall of depreciation. It's going to drive my income down to 10% tax bracket. Well, my question to them is, now I want to find income. So now I want to do let me do a $100,000, $200,000 Roth conversion, right? When I'm in these very low brackets, right? Because I want my marginal rate year over year for my client. If they're a 22% marginal rate person, I want them to be at 22%. But if I get a big deduction, that's going to drive my income down. So where do I find, if you will, other income to pay cheap tax on? And a Roth conversion is super sweet for that.
Yeah, you could stack a lot of things together. I mean, you could look at a donor advised fund, look at a piece of equipment with accelerated depreciation. Last topic, we got about 30 seconds here before we run out of the time on this show. Regarding that, what we were just talking about, that acceleration, I think it makes a lot of sense for like rental properties to take a look at that and then maybe doing some cost segregation study. I think you really come out really nice. Just wanted your thoughts on that as we wrap up here.
Yeah, the bigger place we see on the cost segs on the rentals is in the commercial arena. And so, for example, if you have an Airbnb, or I use that generically, but a rental of 7 days or less average customer use, because that is a commercial by definition, and you can cost seg those. And a cost segregation is nice. You don't have to do it in the year of acquisition. You can actually do it in a later year. So you can say, I didn't do it for 3 years. Now I can do a cost seg and I can recapture and I can pull in all that prior depreciation from older years and get a windfall. So there's a lot of tools out there to be done.
Gotcha. Kelly, it's always great having you on the show. We really appreciate it. I appreciate you being a resource for our firm and just always there to answer our calls and questions and to correct us when we're on the air. I hope you have a great rest of your time out of town. So we'll talk soon.
Thank you.
And if you're catching this show on the way to church this morning, you can hop out to Apple Podcasts. You can hop out to the Spotify platforms and listen to the whole hour. If you would like to call to set up a discovery session, you can actually do that, 256-937-2010. Again, our number is 256-937-2010.
If lingering doubts like, have I saved enough? Or will my retirement funds endure? Are on your mind, it's time to consult with Chris Wallace. Text VISIT to 256-937-2010. That's 256-937-2010 to book your appointment and get the answers you need.
Are you a federal employee feeling pressure from the early retirement offers like VERA, VSIP, or the Deferred Resignation Program? Recent government initiatives have introduced significant changes to federal retirement programs, making employees feel pressured to consider early retirement or face potential layoffs. At WG Financial Group, we help guide federal employees through these uncertain times. Our team understands the complex federal retirement systems and can help you make informed decisions. Call 256-937-2010 to schedule your complimentary discovery session with us today. We'll help you assess your options and create a personalized retirement plan to help you feel more confident. Visit WGFinancialGroup.com or call 256-937-2010 to book your session. Firm is not affiliated with the U.S. government. Investment advisory services offered through AE Wealth Management, LLC, an SEC registered investment advisor.
Market fluctuations can be unsettling, but a resilient plan can help maintain stability. Discuss how you might fortify your retirement strategy with Chris Wallace. Text VISIT to 256-937-2010 today to begin. Remember, text VISIT to 256-937-2010.
Yeah, take advantage of this complimentary discovery session that Chris is offering you, a chance for you to come in and meet the team and visit with them. They'll take you through the RITE retirement process. And remember, you can find us online at wgfinancialgroup.com. And thank you so much for joining us today. You are listening to the RITE Retirement Show. So happy to have you along with us. I'm Luann Fulmer here again with Chris and Graham of WG Financial Group. So, guys, why don't we get into estate and legacy planning? We'll do a little shift here from talking taxes, which was great. Man, Kelly sure has a lot of great things to share. So I'm so happy you have access to him. You know,
he's an encyclopedia.
Yeah, he is.
On taxes. I mean, it's
He's fantastic.
Yeah, he loses me, and I feel like I have a decent understanding. I'm not going to say that I'm like the world's greatest advisor that understands all tax, but I feel like I have a pretty good comprehension level, and he just makes me feel dumb when he starts talking and going into it.
Wealth of information there, right?
Yeah.
Oh my gosh, yeah. Well, okay, let's get into some estate and legacy planning, because a lot of people think, that's just for people who are wealthy, but not necessarily true, because what it can do is preserve your wishes, and it makes you have a plan for your loved ones, no matter how much money you have. And all right, let's talk about why this is all part of your RITE retirement process that you take people through, Chris, estate and legacy planning, why it's so important to everybody and their finances.
It's the E in the process, right?
Yeah.
RITE.
The last one. Yeah.
Yeah. E, the last one. So, it's really important. I think there's most of the time when I meet with families, I feel like that they're missing the boat in this area often. And it will start even as just as basic as the legal documents, the will, the power of attorney, advance directives. And a lot of families that we sit down with, a surprising number of families that we sit down with don't have any legal documents whatsoever. And we're not attorneys at the firm, and we don't give legal advice, but it is one of the things that I do ask about when I'm going through my discovery process and I'm getting kind of close to the end of the meeting. It's one of my last sheets, and I just start inquiring about their legal situation, because as a certified financial planner professional, you want to make sure that your family is aware that they should have those documents in place. And we ask some additional questions around their particular situation that might enable us to guide them to a different type of attorney. Depending on the situation, if it's pretty simple, pretty straightforward, we will use one attorney. If we've got a situation where we've got a blended family, maybe the kids might argue. You just don't really ever know, honestly. Or maybe they've got a special needs child or something like that, then we'll look to refer out to a different attorney. So I sort of make the determination in the meeting whether or not, or which attorney we use. And it's really based on some questions that I asked there.
Yeah. And, you mentioned it. Some families do get torn apart. Feelings get hurt, just, whatever, if they're not happy with the way the parents' estate is split. Graham, tell us what you guys have seen, maybe some problems that you've seen when an estate plan is outdated or even non-existent.
There can be a whole slew of problems. I mean, that it is one of the areas, well, maybe the primary area that's going to affect other people more than it affects you. And it can affect you in some ways. You want to have your advanced directives, your end of life wishes, all of that kind of stuff that affects you. But, a lot of it is what's going to affect the people when you're gone, whether that's your spouse, whether that's your kids, whether you're leaving money to other people, doesn't really matter. I think that some of the big things you'll see is, if someone dies without a will, what I usually tell people about this is the most important thing, to start out on is make sure your beneficiary designations are up to date. That's usually, number one thing, not just because it's really easy, but because it actually trumps whatever's in the will. So, the example we'll give sometimes is if your IRA is beneficiaried out to your wife and your will says that your IRA goes to Ronald McDonald, it's going to your wife, not to Ronald McDonald.
Mhm.
So it doesn't really matter what you put in your will if your beneficiary designation is saying where that's the primary thing. So once you've taken care of that, there are other things like your house, your cars, your personal property, things like that are not going to pass through a beneficiary designation and usually would go through a will or a trust. And, it depends, like Chris said, on the situation of what is going to be necessary there. Is it really simple? Do we basically just need a will to have a house pass, or do we need a trust? I'll give you an example of someone that told me a story, of something that happened to them in their own life where their parent, their dad, got remarried later in life. So it's a dad and a stepmom.
Okay.
And their dad ultimately wanted to leave his house to his daughter, but he wanted his wife to live there. There are ways to do this correctly in the law. It's life estate. There's very, I wouldn't say necessarily like super easy, but you can get with an attorney. You can get this set up correctly. What he did is he said, okay, well, I will just leave it to my wife. And then when she dies, she'll leave it to my daughter. Perfect, right? What could go wrong?
Right.
Well, what could go wrong is that there is nothing actually binding the wife after he died to leave it to her stepdaughter.
Oh, no.
So she ended up willing it to her daughters instead of her stepdaughter. And she did not ultimately get her inheritance. So that's one of those situations where, proper estate planning could have very, very easily avoided that. Basically, to say, hey, we can accomplish this wish of, we can make sure that your wife can live in the house, because that's totally understandable. I'll give a shout out to my grandfather. I'm pretty sure he has done this and done it the correct way. So that shouldn't be a problem for my family like it can be for some people.
Mhm.
But,
Right.
I think that it's really important to have all that in place just so you don't leave a headache for your heirs, or so that your wishes are, not honored in the
Right.
way that you want them to be.
Yeah, his wishes weren't honored. It's heartache for the daughter too.
Yeah, you took one scenario right off my notes here, Graham. So I don't know if you're like peeking over on my side of the table here.
Maybe it's the same scenario. Yeah.
The named beneficiary is the one that you mentioned. It's really, really powerful. It is. A lot of people just assume, well, it's in my will. It's in my will. It's fine. It's in my will. Well, if you name a beneficiary, that is really the most powerful form right there. Well, if it's named, that's where it's going. So to Graham's point there, you can have that named beneficiary and then a different person in the will. That named beneficiary on that account is going to get those funds or the asset or whatever. One other thing I want to mention here, because I've run into this before. That's actually a great story, by the way, your story. And I was at lunch with one of our attorney referrals last week, and they told a story very similar to that. So now I'm wondering if it's similar client, overlap there.
Yeah,
you know, what I mean?
Probably not. Well, maybe, I guess.
Or
You
it
never
happens
know.
all the
Yeah.
time.
Small
right?
world.
Yeah, but just very, very similar situation they were telling me at lunch. One of the things that I've run into before is beneficiarying an IRA to one child to be able to distribute it to other siblings. So, for example, we've got mom and dad who have 4 kids, and they've got one really responsible kid, and they want to give everything to that one kid and make the one child then responsible for distributing assets out to the other 3. So here's the problem in doing that. If it's an IRA, and again, you have 4 kids, and let's just say Sally is the most, responsible one, and we're going to have everything go to Sally. So mom and dad have $1 million IRA. They pass away. Sally gets the $1 million IRA. Sally has 10 years to pay the tax on it. So here's my point. When you beneficiary, especially an IRA to one child, you've got all that IRA money going to one child, and now the whole tax liability is in their court. They're now responsible for that.
Oh, wow.
In addition to that, if they're supposed to split that, let's just say 4 ways. So we've got $250 per kid at this point. So one, we just talked about the tax. That's a really big tax bill on Sally. But now she's going to be giving money to these other siblings. And now we've got gifting that comes into play because she's gifting $250 technically to the other siblings. So it's really probably the better way to do something like this would be, one, to sit down with an attorney and go through the situation, talk about what you want, to do at end of life. And really the best thing to do here probably would be set it up in some sort of a trust. So if you've got those 3 that aren't necessarily as, let's say, responsible or whatever, then you can put some limitations within that trust on how much money they get each year. Maybe it's certain age bands, they get a certain amount of money. The bottom line is I think it's a bad idea to have all money flow through one sibling for the reason I just mentioned. But then I also don't think it's great for the potential relationship ramifications amongst the siblings themselves, because one's going to go to the sibling. And I can tell you that if my mom and dad left money to one of my brothers, that thought, that negative thought, because we know how the devil works, will creep into my head and say, well, why didn't they use me? I'm the more responsible one.
Right.
Oh, they just liked him better. And then there could be some potential arguments. So I think when it comes to estate and legacy, and we're talking about some obscure type things potentially happening, but it's things we've run into. It's that the point here is you want to put some thought into your estate and legacy planning and make sure that it's well thought out. And it's difficult because you're talking about dying, and it's just hard to do because nobody really likes to think about that.
No.
Well, and you say obscure situation, and maybe kind of to an extent, but I don't know if this is your experience. I feel like I see the leaving things to one kid, or maybe not one kid, but see something where it's like, oh, all the kids are like in college, and so I'm going to leave it to my brother and then he'll distribute it to my kids. A scenario like that, I feel like I see that all the time. That's very common.
That's a great point.
And, I understand the logic, I guess, behind it in your mind of, oh, yeah, he's responsible, he'll do that. But yeah, I think that can just be disastrous for relationships. So, I mean, a common question is like, do I need a trust? That's like a question that I'll get a lot of times from different people. And I think one of the things you have to think about, there's a lot of sides to that, and I'm sure we'll get into more of those, is, a question I'll ask is like, if, this child, or this child, say I have 3 kids and you have, $1 million, are you comfortable with the thought of each of them just inheriting $300,000 each today? Like, is that okay with you? Do you have any concerns about that, or does that sound great? And if the answer is yeah, then, you might not need anything else to put any sort of restrictions on it. But for a lot of people, it might be like, yes, for those 2, no for that one, or, no for those 2, yes for that one. And, in that case, other types of planning just kind of give you more flexibility. But like I was saying, it is something that you'll see, just more often than you would like.
Yeah, you're right. That's an excellent point. That is one that I do see more frequently than maybe the other story about the life estate.
Yeah.
Not doing that properly, for sure. What we're just talking about also reminds me, I think, I'm just trying to think through this carefully how I say it, so I'm not saying anything negative about individuals. But as we get older, I just think that we tend to worry a little bit more. And so in this particular case, using the scenario of money going to Sally or going to the responsible, brother or something like that, I think you also can run into that same scenario where it's going to be tempting as you age to put your kids on your bank account. And we think that is a really bad idea. Some of the people that we've run into have large amounts in checking and savings. So the thought process, again, in theory, it makes sense, right? So it's like, okay, I'm getting older and I want to make sure that there's a name on the account so that if Sally needs to come get money to pay for my nursing home or whatever kind of care, they can do that. But if you add that person's name to the bank account as a joint owner, then it does open that account up for liability. Let's just make an example. If Sally goes out, has a car accident, and hurts a family, Sally's sued. Sally's name is now on mom and dad's bank account with 6 figures in it. That bank account technically could be in line for the lawsuit, could be available funds in the lawsuit. So you want to think through this for sure, but we just advise speaking with an attorney or an estate professional just to second guess some of the things that you're thinking, because what feels and sounds right to us can be wrong. I've made decisions in my life that just sounded right and they ended up being the wrong decision, and you learn. And what you don't want to do is you don't want to learn the hard way. You don't want to do that on the financial side. You don't want to do it on the estate side. And that's why those professionals exist. That's why Graham and I are certified financial planners. And that's why we also refer out to professionals like CPAs and attorneys as we see the need.
So as you're listening and you're thinking about maybe questions, the first place to start is to give Chris and our team a call at WG Financial Group. So I want to give you the phone number. You can call or text the word visit to 256-937-2010. It is a complimentary discovery session, and they can help you with a retirement plan. It includes everything from your retirement income to investments to tax strategies and then estate and legacy planning. It's the RITE retirement process that Chris and the team take you through. It's a plan, a process that they've worked so hard on. And this is how they help people plan out their retirement so they can retire with confidence, so they can, after they plan, so that they can retire and play. Plan, retire, and play. That's the motto. In fact, if you go to our website, WG Financial Group, you're going to see that plan, retire, play. We want that for you. And that's why we do this show. Thank you for joining us. This is the RITE Retirement Show with Chris Wallace, president of WG Financial Group, and Graham Bauer. So I guess I want to ask, Chris, if someone is just scared to get started, okay, just because it's a lot, what would be some major points they need to consider addressing right away? Either one of you, Chris or Graham.
Well, Graham, do you want to take it? Do you have any thoughts there?
Yeah, I mean, I think that kind of like I mentioned earlier, the biggest thing I would look at is just beneficiaries on every single account. From your bank account, that's a big one that people miss. Your life insurance, that's one that can get missed sometimes. Your IRAs and your Roth IRAs and all 401ks, everything. Because, another thing, if an IRA account doesn't have a named beneficiary, it actually changes the required minimum withdrawal rules for them. So, for example, if you're 62 years old, you pass away, and your beneficiary is IRA left to your daughter, let's just say. She has 10 years to pay the taxes. She can kind of take distributions as she pleases, but the account has to be emptied within 10 years. That actually moves down to 5 years if you don't have a named beneficiary. The account might still make its way to your daughter through the will and through the probate process and everything. It's going to take longer. It's going to be more expensive. And on top of that, she'll only have that 5-year window instead of the 10. So I think that that is the number one thing I would look at. And, if you have young kids, maybe even a place to check before that is having a will to have guardianship provisions. That's something that people will also miss a lot of times. They'll think, okay, well, we're younger. We don't, have a lot of assets saved yet. We probably don't need a will. We don't, own a house. Well, you got to make sure you have guardianship provisions at the very least, because, if you have children, you pass away, the courts are just going to decide if you don't have anyone designated. And, there can certainly be some messy situations with those two. So I think that's kind of, 1A and 1B, depending on where you are in life, just to make sure you're not missing things that are really, really simple and really, really easy to take care of.
Yeah. Here's the other thing too. If you're going in to speak with an attorney and you're considering a trust, one of the big things you want to make sure of with a trust is that the trust is funded. So this actually happened in my own family. So we were talking about my dad earlier in the show. Finally, after years and years and years of talking with my grandfather, he decided to set up a trust. So one of the things that I just told my dad as they were going through the process was just make sure the attorney funds the trust. And so my grandfather ends up passing away. I talked to my dad several weeks after the passing. I mean, I talked to him in between there, but as we were just talking about the stuff that he inherited, and I asked, I said, is the house for sale? And he said, no, actually it's not. It's going through probate. And I was like, wait, Dad, you did the trust. And he said, well, yeah, the attorney didn't fund the trust. And I was like, Dad, I reminded you to do that, to talk to the attorney about that. So if you get a trust, that's great. Just make sure the items that you want in the trust are funded. Graham was mentioning beneficiaries. Excellent point. It's a very easy one to to look over and just miss it. So especially like bank accounts, especially after divorce, you want to go through and make sure all of your beneficiaries are set up right, and so that your ex-husband doesn't get your assets if you pass away. One of the other things I want to touch on, this is something we talk about at the office quite a bit, is if you have age of majority kids. So they could be teenagers or they could be grown adult children, in their 30s or maybe even 40s. A couple things is if they're single, especially if they're at college, and I went through this with my own 3 kids who are all age of majority. I have power of attorney and HIPAA waivers over them because they're age of majority. They can make their own decisions. But if they were to be hurt at college or get in a car accident or, they just do college things or whatever, I can't make decisions without those documents.
Right.
So for parents out there listening to the show that have single kids that are in college, it's really important to make sure that you have those documents. And actually, in the state of Alabama, this is one of the things that came up. I don't think I've shared this with you yet, or maybe I did in yesterday's notes meetings where we were talking, Graham. But in the state of Alabama, a 14-year-old can really consent to their own medical care here in the state of Alabama, which is kind of a little bit crazy. So parents may want to consider HIPAA stuff going on, speak to an attorney about that, even when their kids hit 14 here in the state of Alabama. So lots of little things why, we've talked about on the show before, Lou and the team. So having a good CPA, a good tax person, a good attorney, and a good, certified financial planner. I think having those people surround you, part of their job is to actually protect you and your family and talk about these types of things so that you know about them, because that was new on me, because I was eating and we were talking about, things that we talk about with our clients, and they threw that at me and I was like, whoa, wait a minute. I didn't know that here. So, I'm kind of in the industry and I have younger kids and all that, but this would also go for, this POA and HIPAA waiver thing would even go for if you have like a divorced son or daughter and they're like 43. It's like, okay, well, they're age of majority. They're not the teenager anymore, but somebody still needs to be making decisions. So is that going to be the brother? Is that going to be the sister?
Right.
Is that going to be mom or dad? So just keep those things in mind. Don't think everything is going to be okay, because none of us know like when the end of our life is going to be. And so, or when we're going to have a major event happen. So just kind of keep that in mind as you do your estate and legacy planning.
Right.
Yeah. And, one last thing I'll add to that. Yeah, I always tell people on that note, it doesn't have to be the parents that are the power of attorney. That we'll always start there because they're a lot of times the responsible ones that are sitting down with a planner and thinking about it.
Yep.
But, I can understand that going to your 34, 35-year-old son or daughter and saying, hey, I want to be able to make financial and medical decisions for you can maybe sound a little jarring before you explain it, even though, it is for their own good. So, we just like to say, hey, talk to them about it. Let them know that, if they have a sibling that can do it, a really trusted friend, a different family member. It doesn't really matter who it is. And you can also set it up, what's called springing, meaning that, it doesn't spring into effect until an event happens. So
you're looking at my form again. I just jotted that note down. By the way, he can't see. His laptop is blocking where I'm writing, but it's really funny. I just literally made a note of that.
That's hilarious.
Thinking the same way, but it's one of those things that it can make it sound a little gentler to tell an adult child that, to say, hey, I want to get this, but we're going to set it up springing, meaning that it's not really going to be usable unless something happens to you and you become incapacitated. And then at that point, I can make, medical decisions on your behalf. So It is an important thing because, a lot of times we'll tell somebody about that. And, if they already have it, I found that a lot of the times the reason that they have it is because something happened already to one of their kids where they needed it in the past.
Right.
Most people don't have it because they just know that it's a good thing they should have. Most people say, oh, yes, we have that because, Jimmy got in a really bad, he got, in a car accident and we had to make medical decisions. It was really stressful. So now we have it for all our kids.
Wow.
So it's one of those things of, trial by fire, kind of learning the hard way that can be avoided if you just get ahead of it.
Yeah, that's, you're exactly right, Graham, about it's difficult to go to an adult child and say, hey, I know you're 38 and, but I want to be your POA. It was a lot easier. It's a lot easier for your college kids because I'll just tell you how the conversation went with Caleb and Christian. It was very simple.
Yeah.
It was like, I'm paying for your college, I'm paying for your car insurance, and I'm actually buying some of your groceries. Sign these documents.
Right.
It was that simple.
There you go. Done.
But to Graham's point, when they're older, it could be a little, different of a conversation, and you might have to think of a different person being that, POA, or you can just use a springing version. So again, great stuff, Graham. Excellent.
Yeah, really good stuff. And, one thing I want to bring up, every single person's legacy plan is different. There's not a one size fits all. So when you guys get to this part on your RITE retirement process, estate planning, do you do an estate planning analysis for them?
We don't necessarily do the analysis. I mean, all of the things that you've heard us talk about for like the last 15 to 20 minutes is stuff that we ask. And it is on our trademarked report card that we use. So we don't actually, I wouldn't say we do an estate plan analysis. We just poke around and ask some questions which lead the prospect or the client down the road of whether or not they need to sit down with a professional to go through that. So I don't want to call it an analysis, but just say that, I mean, obviously we've run through probably, 5 or 6 solid good bullet points here in the last 10 or 15 minutes that if you were listening to the show and you have kids or you don't have legal documents, that you should have been frantically writing down notes about things you need to go take care of right away. So I wouldn't call it an analysis. Just say that we look at it. Let's put it that way.
Okay. Yeah, very good. Ask questions. You ask a lot of questions.
Oh, for sure. We ask a lot of questions. We do.
So, okay, let's get into some inheritance taxes, okay? Because if someone inherits, some money, they're going to, you've kind of talked a little bit on it, but can we get into any taxes that heirs might face?
Yeah, it's not much of an issue, honestly, nowadays, because with the OBBB that got passed, I love to call it the OBBB. It just sounds really cool to say that.
OBBB.
Rolls off the tongue.
Yeah.
OB to the third. It could be OB to the third, too.
It could. Yeah, that's good.
Anyway,
excellent. Yeah, it's not really much of an issue because I think, is it like $15 million per person?
Yeah, we're up to, for a married couple, like $30 million estate. So, hey, I mean, there are people out there that it could still affect. But, I heard...
Graham, how are you and Emma doing with that? I mean, I know you're
we're getting hammered.
You're bumping up against that limit already.
Just kidding. I wish. The one thing that... I remember one of my instructors at CFP training said a while back is when we got into the estate tax section, he said, people who pay estate taxes don't have very good financial advisors. And so, for the people in those brackets that they're actually going to, get to that point, there's a lot of things you can do, but just frankly speaking, based on how high the limits are, just not many people are going to face that. Yeah, no, they're not. And just for some knowledge, just to kind of throw out some education here as we get towards the tail end of the show. If mom and dad have a joint with rights or survivorship, like an after-tax TOD account with stocks or mutual funds or ETFs, if they pass away, then there's a stepped-up value that happens. The house, if mom and dad own the house and mom and dad pass away, the house is generally inherited at a stepped-up basis, unless mom and dad have taken some really bad advice and added the kids to the deed and done it outside the legal way to do it, which we'd always recommend speaking to an attorney. Then you can inherit those stocks I just mentioned at a stepped up value, so no tax, and literally sell them the next day with no tax. And then you get the house at a stepped up value. There's no tax. And of course, you inherit IRAs. You inherit the IRA, you have 10 years to pay the tax. Or if you use a CRT or a charitable remainder trust, and you stretch it out over 20. So as far as the inheritance tax, it's not much of a concern nowadays for the vast majority of people. And I would say most of the people that, that we work with don't have anything to worry about. And that includes me, and that includes Graham. So as we wrap up here, Luann, been a great show. Enjoyed having Kelly on the first half of the show to talk tax and OBBB. And then love this estate and legacy stuff. Kind of a sad stuff to talk about in some cases.
That's so important.
Very important. Very, very important. So if you'd like to set up a time to come in and talk to Graham or myself, give us a call, 256-937-2010. Our number is 256-937-2010. I hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
Kelly Myers is not affiliated with WG Financial or AEWM.
Graham Bauer holds the enrolled agent designation, but is not currently offering tax preparation services. Neither the firm nor its agents may give tax advice. Individuals should consult with a qualified professional for guidance before making any purchasing decisions.
Investment advisory services made available through AE Wealth Management LLC, AEWM. AEWM and WG Financial Group are not affiliated companies. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Financial Group are not affiliated companies. companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only and is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. WG Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial. This radio show is a paid placement.